Aside from the risk of a systemic shock, we are seeing economic growth markedly slow in Europe and Asia, particularly in Northern Europe, in the core, in Germany. What's your sense of whether the global economy stalls here or, even worse, relapses into recession?
So, as you say, we are in a synchronized slowdown. Europe has entered recession. It wouldn't surprise us if its growth rate is running at -1, -1.5. China is slowing from the 10 to 12% growth rates of the last number of years, more to 6 to 7. The US is having difficulty recovering robustly. So wherever you look, we're having this synchronized slowdown, and that is an issue. So far, the baseline doesn't include a recession. Now, how do you get a recession? There are four major risks. We've been talking about one of them, which is a European crisis, a banking crisis, a debt crisis, something like that. That would push the world into recession. Second, in the US, we have a fiscal cliff. Okay, 4% of GDP risked to be withdrawn unless our Congress does something. And if they don't, then this would push the US into recession, would push the world into recession. Third, geopolitical concerns out of Iran and Syria. That could push oil prices high and act as an element of recession. And finally, China is navigating a very challenging situation right now. So these are the four risks. All you need is one of them to materialize, and then the probability of a global recession will go up.
If we look at the developed world, you see ballooning deficits, low interest rates, slow economic growth across the board. Are you worried that the developed world is in the midst of a Japan scenario?
Well, the developed world is in the midst of what we called the new normal. Remember, we came up with that in 2009, and our sense was that this time around, the recovery wouldn't be your vanilla type recovery. Right? It's a little bit like dropping your phone, that when you turn it back on, not everything is going to come back on. There would be a new normal, a new destination for your phone, and we thought there would be a new destination for the West. And that destination is sluggish growth, persistently and unusually high unemployment, and recurrent debt and deficit concerns. Now, why? We came off a period of incredible leverage, what we call the great age. Not great in terms of good, but great in historical terms. It went too far. Great age of debt and credit entitlement. People believed that they were entitled to do things based on credit and not income. That means we borrowed growth from the future. We borrowed employment from the future. And now we are trying to get back into an equilibrium. So unfortunately, until our policymakers realize that they need to be much more agile, much more secular, much more comprehensive rather than sequential, okay, we are going to go through this new normal time with persistently high unemployment.
Right, and I remember when you came out with this projection for the new normal back in 2009, you forecasted it would last, 3 to 5 years. So here we are, 3+ years into it. How much longer do you foresee that we will remain in the new normal? Has your time frame lengthened?
So there were two things that we did not foresee fully. The first one was that the new normal would contribute to political dysfunction. And you see this political dysfunction in the US. You see a Congress that's highly polarized. Think about it, Jennifer. We haven't had a budget for 3 years.
Right.
That is a basic element of economic governance that we haven't had because our Congress is so polarized. And of course, the regional politics in Europe has been very challenging. So the first thing we didn't foresee is that bad economics would contribute to bad politics, which in turn would contribute to bad economics. The second thing we didn't foresee is that policymakers, rather than embracing the concept of the new normal and being very agile in terms of their policy response, would deny it. So yes, we are in year 4 now of the new normal, but unfortunately it may continue for a little bit longer because the politics is now adding to the challenges.
Here we are at zero interest rates, and it's not inducing as much investment and spending, perhaps as earlier points in the recovery. Are we trapped at zero interest rates, and are markets over-reliant on unconventional monetary policy? Should the Fed continue to pursue these unconventional measures, or do the costs at this juncture outweigh the benefits?
So the reason why we're at these artificially low interest rates, and I stress they are artificially low, is because that's one way of trying to de-lever an economy, right? If you can't grow out of your debt problems and you don't want to default, right? What you do is you try to keep interest rates very low so that your creditors are subsidizing your debtors. So if you have a CD today, a certificate of deposit, you're miserable because you're not even getting paid the rate of inflation. But if you happen to be buying a house, or if you happen to be buying a car, or you have to refinance either of these things, you're getting really cheap interest rates. So the reason why the Fed is suppressing interest rates is to navigate a transfer of income from creditors to debtors. That's why they're doing it. The problem is that this has collateral damage, right? You can't run economies at artificially low rates. Things start to break. You're seeing tension in the money market segment, the pension industry, in the insurance industry, even in the way markets function. So the Fed has to express a judgment on what Chairman Bernanke called the benefit, costs, and risks of unconventional policy. Their belief is that so far the benefits still outweigh the costs and the risks, but they have also acknowledged that this trade-off is starting to get worse over time.
Okay. Switching gears, your colleague, Bill Gross, recently drew a lot of attention when he proclaimed, quote, that the cult of equity is dead and that stock investors will have to get used to lower returns. So what kinds of returns should stock investors expect over the next 10 years?
So the cult aspect speaks to the returns and to some other things that I'm going to talk about. We grew up believing that we can rely on our equity for anything from 8 to 12%. That's what most people have in the back of their mind. Right. I think we'd be lucky to get 4 to 6 nominal, which means that if you're going to maintain the same objective in terms of total returns, you're going to be disappointed. So the first thing about the cult of equities that's dead is this notion that the returns are God-given somehow. Well, they're not. They're a function of what the economy is doing. They're a function of valuation. And unfortunately, we're going to have to work to get to the 8 to 12. You can't just do it from the equity side. The second thing about a cult is it believes that certain relationships never change. It believes that correlations, in particular, between equity markets and other asset classes are fixed. They're not. We're witnessing in front of our eyes a change in correlations. So it's very important to update the equity story to recognize it's not just about lower returns, but it's also about changing correlations. Final element of a cult is your comfort zone. For Americans, there's a very high home bias, which means that we are comfortable with things that we know, right? So we tend to invest a lot in the familiar because the names are familiar. Right. Why did so many people get burnt on Facebook? Because they thought, well, it's so familiar. Okay, I use it every single day. Therefore, it must be investment. But that's not how investments work, right? And the third element of the cult that's going to be changing is people are going to become much more global in the way they allocate their equity exposure.
So then where do you go? How can you maximize returns? Is it about finding those individual stocks that are going to outperform the broader market? You said asset correlations are breaking down. They're not what they used to be. Certainly I've heard from certain experts that the secular bull market in bonds may be coming to a close. Certainly some areas are more attractively valued than others. I mean, where do you go to maximize returns? How do you invest?
So the first thing you do is you modify how you think about all this. So the old way of thinking about this, and many people are still hostage of that, is you pick a number, 6 to 12% returns. That gives you an asset allocation. You say, well, I'm diversified, and you think, you know what, this is great. This asset allocation is going to do all the heavy lifting for me. It's going to generate returns, and through diversification is going to manage my risk, mitigate my risk. In today's world, where there are potential accidents, we spend a lot of time about Europe, there's the fiscal cliff, there's geopolitics, all the things we've been talking about. The first question an investor should ask his or herself is, what mistake can I afford to make? Okay? Because the chances of you making a mistake goes up in a world that is so uncertain. The minute you specify your risk appetite, so you start with your risk appetite, not your return objective, your risk appetite, it will translate into certain asset classes, which will translate into certain elements of the capital structure, which will then translate to a return objective, right? And if that return objective is not high enough for you, well, you better look again at the risk element.
Thank you so much for coming on the program and sharing your insight. I so appreciate it, and I hope to see you soon.
My great pleasure, Jennifer. Thank you for having me on.
Mohamed El-Erian, CEO and co-CIO of PIMCO.